Hello, everyone. My name is Michael Patanella, audit partner at Grant Thornton. I'll be your moderator today. We have a great panel to talk about growth equity, and I'd like to introduce Martin to the group and then ask him to do a quick intro.
I'm Martín Escobari. I'm co-president and I head growth equity at General Atlantic, 107 billion AUM.
Darren?
Great. Hi, everyone. I'm Darren Cohen. I'm the CIO of the Growth Fund at Goldman Sachs.
Jim Pittman. I'm the Executive VP of Private Equity and Venture and Growth at British Columbia Investments. We have 250 billion AUM and about 32 billion in private equity.
Hello, everyone. I'm Matt Diestel here. I'm a partner and head of US for private equity and venture capital in the US for QIC, the Q being Queensland, Australia, which is where we're headquartered. It's about a $70 billion alternative-focused asset manager. We manage capital on behalf of the Queensland government as well as third parties in Australia as well as internationally.
Great. And this is a great panel. We have both investors and the LP side, so we'll be able to hear a little bit about both sides of that angle. So Darren, we're going to start with you and talk about some of the kind of significant resets that have happened over the years and how the environment has evolved in 2025 for the growth.
Yeah, so I think it's always helpful to start, for people who don't live and breathe growth every day, is just to appreciate the magnitude of the last 5 years and the moves in both capital and valuations. If you go back to 21 or even pre-21, generally all we do is software and technology. It's historically traded 5 to 10 times forward revenues. You go into 21 and into COVID, it got up to 30 to 40 times forward revenues, and it was just unsustainable, and it was a peak moment where capital was flooding the sector. And then literally 18 months later with inflation and then the rate cycle tightening, multiples came back down to, I would say, 5 to 10, and I think we're in an equilibrium now, around 8 to 12. But the repercussions of that over the last 4 years, I think, have reshaped growth. I think the competitive landscape is much healthier today. You've seen most funds that entered into growth at the peak retrench. So it's a healthier competitive environment. It's a healthier deal environment because there's less capital. Capital at the peak was roughly 500 billion into growth. Today it's 180, 200 billion. And then I think the CEO mindset has shifted tremendously from like growth at all costs to focusing on building sustainable, profitable businesses. So I think we're kind of in an environment now where there are these tailwinds that it's very unique to have this kind of backdrop on valuation with thematics like AI that are some of the most interesting thematics I've seen in probably 2 decades.
Great. Martin, can you maybe talk a little bit more about AI and some of the advanced analytics that are keeping you competitive in this post-election environment?
Sure. Let me second what Darren said. We think the current growth equity market is the best growth equity market since '09. We're seeing pricing we haven't seen since I was a young man, and that was a while ago. One of the big drivers of the opportunity set is there hasn't been an IPO market for 3.5 years. That's the second longest period without IPOs. The first longest period. The second longest was 18 months in 2000. And we have a lot of GPs that are getting pressure for DPI and are putting some of their best companies for sale. So over the last 2 years and probably the next 2 or 3 years will probably be the best cohort of the last 20. Very, very excited. One of the big themes in growth equity is how technology disrupts many, many industries. That trend is 20 years in the making. AI has accelerated. AI is working. Across the portfolio, we see it. Wherever you apply AI to a process like customer service or digital marketing or programmer efficiency, you see 20, 30, 40% productivity gains today. So it's real, it's being used, it's impactful. It's been hard to invest in AI because if there is one pocket of bubblish behavior, it's been AI. On the infrastructure layer, massive investments, lots of technology risk. DeepSeek highlights some of that. Size may be overestimated, so forth. On the application layer, it was too early. It was more venture-like, but valuations were growth-like. Wrong. It's finally gotten to the stage where you're seeing leaders emerge on the application layer, and valuations are more reasonable. And we just, after 5 years meeting everyone in the space, we made our 3 major investments in AI last quarter. So I think growth equity, finally, the application layer is ready for growth equity, and I think it'll be a very good opportunity.
Great, and I'm going to stay with you, Martin, just to, you talked about some of the positives. Can you talk about maybe some of the challenges that you currently are seeing based on, these positives that you have in growth equity?
Listen, all of us that are active in the space, whatever we bought in 21 and 22, the multiples, even if you were the most sober person at the party, you had a cocktail or two, and we overpaid for it. So the painful thing has been working through that and getting to profitability. The good news, at least for us in the 21 and 22, we've grown ourselves into the valuation we paid, and those companies are still compounding at 30, 40%. So I think we're going to be okay, but it's been painful.
Right. So the companies are doing better, and the multiples have gone down, which opposite of what we usually see.
And Martin, one of the interesting things about that, I hear a lot of this in private equity, is that many of my companies in 2021, maybe early 22, it's going to take me a while to commercialize them, to get some value. My company is going to grow into its value. That to me is, there's two interesting statements I hear in the past 3 years. Companies will grow into their value, and DPI is a new IRR. Those two things are the most intriguing pieces to someone who sits and tries to put a value on their portfolio. Very interesting to me.
The one thing I'd add to that, Jim, because those are great points, I would agree with the sentiment that it is a very interesting time to be a growth investor. However, you have this, whether it's the quality of revenue or the endurance factor that you put to that revenue growth, even though multiples are off and they look attractive, how do you think about the runway for growth in your businesses? Even though they have become capital efficient, they are fit, the unit economics hold.
I say that death, taxes, and being valued at multiples of cash flows are three things you can delay, but you can't avoid. So the trick of valuing these young companies is predicting what their forward profitability is going to be, and you bring that to present value. Now, I believe, and I don't know if you agree, generalist private equity in growth equity is dead. You need to be a specialist. So to be able to do this well, you have to choose the business models you're going to be a good predictor of, stick to those, and you're probably going to get it right. It's getting harder.
Matt, I would just say the other dynamic, and this relates to liquidity, is I think there's a belief that really gross exit is the IPO market. If you go back for us over 20 years, 2/3 of our companies get bought by strategics and financial sponsors. And so the wall of private equity capital really becomes a great outlay, particularly as these companies get to maturity and get to profitability. And I don't personally see a vibrant IPO market coming back. I think we're kind of in a different environment where the best companies in the world are going to stay private for longer. To Martin's point, that's an awesome opportunity late stage to step into those companies if they're priced right. So I think right now in growth, there are multiple vectors to enter. And the risk returns are getting more and more interesting. So, and I do feel like liquidity will improve, particularly if you look at the top, call it 50 late stage software companies, some of them the best software companies in the world. They're mostly targeting to go public between 26 and 27. And you can imagine the animal spirits come back as some of the best software companies hit the market again.
And Jim, maybe we hit on some of these, but when we did our planning, you were talking about this is now going to be an allocation that you're going to be making, and that you're going to be changing a little bit of your percentage allocation. Can you talk about not only why, and then also, I mean, we hit some of them, but then how you started thinking about building your team and what your outlook is?
Well, I think, as an investor in both private equity and venture and growth, I hear from all of the GPs, this is always the best time to invest, right? So, I've never heard a bad time to invest, really, maybe 21, so it's always a great time. So to me, back in 2019, we allocated $1 billion to both venture and growth. And to date, almost 5 years in, we're still only halfway there. And the reality is, during 19, 20, 21, you had 3 days, 5 days, 7 days to sign term sheets, right? Like, as a pension plan, the one thing we have to calculate is risk and the related return, right? In 3 days, I'm not that smart. I can't figure out, how much risk is embedded or what the return is going to be. So I just pass it to the GPs. I said, that's your job. You get paid 20% to sort of figure that out. What I'm looking for are de-risked investments. And that's part of the reason why we're much further behind than you are in terms of where we have placed venture and growth, right? And so we've probably allocated of the 500 we've invested, 200 million towards venture, 300 to growth. And we will do co-investments, but we've tempered our timing on it. I would say these days we're more keen to invest more capital. Because maybe it is a good time to finally invest.
And Matt, maybe talk about the contrast where you are in your journey with growth and what you're seeing in deploying some capital.
Yeah, sure. So we've been doing it a bit longer. So we've been investing in venture-backed growth and growth equity since our program inception in 2005. So, been very fortunate to be, building GP relationships and exposures through what was a very favorable time for all growth assets. The way we navigated the last cycle here was, really almost taking the Bill Gurley, philosophy, and that you need to take these cycles all the way to the end to be compensated for that hype that you probably get, which we did. So even though we've worn it the last number of years here from a valuation and multiple perspective, we're still playing with the house's money. And the enduring themes that we would subscribe to are still present, right? The innovation cycle is still very exciting. These businesses are more fit and capital efficient, so the pathway to profitability and cash flows that we all need to see at some point, to Martin's point, are there. And so that is still giving us excitement to deploy dollars, even though of a $7 billion venture capital and private equity program, about 40% is sitting in venture-backed growth and growth equity, which is overweight our targets. So we're having to navigate that, but at the same time, excited about the future. So we continue to deploy.
Yeah.
That's a big exposure, 45%. Is that mostly because you created so much value in it? You said you were putting
Yeah, it's a combination of a few things. We did see the NAV appreciation that was in excess of what we would have modeled, right? So when we were going through, particularly on the venture treadmill of things, the 2-year fundraise cycle that we saw even from 2012 and 2014, we were just having to deploy more rapidly into the asset class, and we didn't want to lose relationship with top-tier venture practitioners, because those are groups that you need to have the exposures to. You don't want venture beta. And then on the growth equity side, we saw the same thing. And so we were happy to be deploying and building those exposures and getting that compounding that we are now on the receiving end, because we're overweight. But again, we're happy to wear that risk at this moment.
It's okay to be overweight if it's profit,
Yep.
Yeah. Let me react to Jim's dilemma that everyone pitches him that this is the best time for their firm and their industry.
Let me hear your best statement. Come on.
Yeah, this is the first time I've said this is in my career, and I've been at it for 20 years. This is the best time for growth equity. And I'll give you 2 numbers that are undebatable. If you look at the average multiple of a public company and the average multiple of private transactions, Russell 500 and the PitchBook data, there's now a 50% discount. It's the largest discount in the 20 years they've been tracking it. That's a fact. It's never been this high. If you, on the other hand, another out of flavor asset class, emerging markets. We do about 20% in the emerging markets. Average multiple in the emerging markets to developed markets it's now 75% discount. It hasn't been this low since World War II. It's a fact. Now, is it a perfect predictor of future returns? No.
It's a good enough
pretty good fact.
Martin, just the other side to that equation is growth.
Yeah.
And if you look at public market software, and actually public market technology, it's actually shocking. In 25 years, there are really, outside of a NVIDIA, there are no publicly traded software companies growing north of 25%. And so when you combine that multiple discount with, if you look at the private markets, the growth rates are 50 to 100% consistently through a 5-year hold. I think what's happened is the best part of a company's growth curve now is just increasingly happening in the private markets. And when they go public, it's going to be late stage, a very mature cycle. Yeah.
S&P 500, 24 times earnings, 24 times PE multiple, highest of the last 25 years, expected to grow at 5.6% with inflation at 3%. How do you make equity returns in the falling markets? It's hard.
Yeah.
Mm-hmm. So 50% discount, but public markets are up, so maybe it's a 30% discount in the end. But at least I have room to breathe and maybe to invest.
Yeah, Jim, there's one other conversation we have with LPs, because a lot of LPs, I think, over time have gone very deep with private equity, mid-market buyout. And I would just say the other dynamic with growth that is super beneficial is our companies don't have leverage. And so the interest rate environment, if it stays at these levels for the foreseeable future, doesn't really hurt our companies. And I think the converse is true. With private equity replicating the returns of the past, it's going to be very challenging. So I do think growth is in this moment where if rates do come down, we'll get a lift of multiples. But if the rates stay where they are, our companies don't have to worry about refinancing.
But I do think Jim is right about a point, but liquidity is harder.
Yeah.
And you said this too, Darren.
Yeah.
To go public in today's world, you need $1 billion of liquidity. So you need to have a market cap of $3-4 billion. So the minimum scale at which you can go public is, I think, permanently higher. Similarly, to merit strategic interest, even though the floodgates of M&A are probably going to open, you also need a critical scale. So I think it's harder in growth equity to be small. Mm-hmm. But if you can scale, the payoff should be.
Well, we see quite a bit of what I'd consider to be private IPO, right? I mean, you're basically doing continuous secondaries. It's not a CV that we typically see in private equity, but you have a continuum of other people coming in at sequential values. So I think that's going to replace a piece of your IPO path, right? Because it provides longevity, right? It allows a company to get to more profitability potentially. One of the bigger problems for me is trying to figure out what's the risk curve, because to me, I prefer to take less risk, more obvious return, because I'm inside a pension plan, right? And that's why venture to me is so much more difficult. Yeah. Growth I can tolerate because I can see a path towards cash flow and or valuations, but we're not going to sort of try to figure out which AI product to jump into, especially after DeepSeek has sort of blown up, what values were out there. So, when we have surprises up and down like that, even in some of the venture or early growth that we've gone into, once we get to a certain exposure, we actually try to de-risk it. We actually try to sell down, because one of the problems is that if we invested 25 million and all of a sudden it becomes 200, and then the 200 goes to zero, we wear the 200, although we put in 25. And so there are sort of other elements around that we as investors in the pension fund world had to be a little bit different about. And I don't know how you think about it, because you've got such a large exposure.
I was going to suggest too, it depends on what you're looking to achieve with your program, of course, right? And you're right, you don't want to do this and do it the wrong way. And it's a labor-intensive part of the market, venture particularly, because it is inefficient and there's a lot of noise. There aren't DPI metrics to really be sinking your teeth into. Growth equity, less so to some extent. But it is, if Martín, you bring up an interesting point around like size, right? And having some scale, and there's probably some economies of scale. We would probably say that we typically like smaller is better. Like we want exceptional practitioners that are more specialized. I think it's hard to be specialized at scale and do everything to everyone. So we in particular parts of that continuum are looking for specialists with certain skill sets to drive alpha. And that's the only way we're prepared to do it, because we otherwise wouldn't, right? Again, to my point, you don't want to buy venture or growth beta. Like you do need to be thinking about putting some real resource to it. And that's difficult within the asset allocator model sometimes.
One of the questions I know you have is how do I build a team around it? And considering, like in venture, oftentimes you can get 20 million, 30 million access, right? My program's 32 billion. I'm going, what am I going to do with 20 million? That's nice, but but how have you guys sort of built how you've gotten to, let's say, 3.5 billion? Yeah, we must have a series of 10s and 20s, but maybe 50s.
We certainly do, and but it is a concentrated portfolio. Again, to my point of really wanting to work with what we think are the best practitioners. We also have a very significant co-investment model, so we can be extension to GPs like Martín and Darren here, where we can slot in alongside of them up front in something that's large, or we can actually be that subsequent round provider as well, where we can get scale and good assets. And we think we're bending the risk curve there a little bit, because we have a relationship advantage, an information advantage, kind of a seat at the table like an insider would. And so that gives us enough conviction to be saying let's double down in assets that are compounding, hitting the marks we want. That helps us quite a bit as we think about building scale.
And so you do it with 7 people in venture and growth, or how many?
In venture and growth across the globe. So there's 7 of us going to 10 in San Francisco, but across the globe there's 14 in developed markets, the way we would talk about that.
And how many managers?
In venture and growth, it's about 20 managers.
It's pretty tight grouping.
Yeah. Now, we've been able to get large allocations to some of the full stack multi-stage firms that are branded, that everyone in this room would recognize. where we apply more of the co-investment model is to smaller, more emerging managers, where we can, again, act like that extension of their firm over time.
Great.
Yeah, maybe it's a good time to switch a little bit to how you evaluate CEOs, founders in making the investments, and what is some key characteristics of things that you've learned on both sides, good strategies, bad strategies that you've seen over your tenure. Maybe Martin.
Yeah, listen, we meet 10,000 companies per year and invest in 20. So we have tremendous range and we have some sort of shortcuts. As I reflect on my 20 years, I look for founder purpose fit. Does this person really care about the mission of the company? Because that gives you an extra energy. The second one is a resilience against the odds. Has this CEO been tested? Has he overcome adversity? And the third one is not really about the CEO, but the people around him. What % of the people around him or her are A+? If that number is 80%, the outcomes are amazing. So it's around the fit, the grit, and the ecosystem this person can bring together.
Looking past the person and the team. Yeah. Darren?
Yeah, I mean, Michael, look, I think what Martín says resonates. It's sort of fundamentally what you would want in a great leader. I'd say with growth, maybe more than other asset classes, getting that CEO right is probably the strongest correlation to performance. One of the things we've done over the last 5 years is just evaluate when we've got it wrong, why have we gotten it wrong? And one of the dynamics in growth that's changing is, I think, what we've brought to our investing team is a group of 50 operators. These are all C-level executives. So the dynamic that I think I've come to realize is like when you put an operator across the table from a CEO, they evaluate the operator from a different perspective. So having the combination of investors who see pattern recognition, they go through hundreds of CEOs a year, combined with an operator, I think gives you a better perspective on, is this an operator that I would want to work with? Do they really answer the questions like a real operator would? So to me, that's just another angle to the question. But it's around vision, strategy. It's, does he or she recruit super high quality teams? And I think the biggest attribute that I've seen as a fatal flaw is just self-awareness. The CEOs that lack that, I think, struggle to scale.
Jim and Matt making an investment when you
I'd say I defer to Matt because he's done more of it. So.
Yeah, no, I mean, just listening to these comments gets us excited because, the way GPs approach markets and companies specifically, and the very simple, components of see, pick, win are, like groups are getting so good at this, right? Like they're building out sourcing models that are technology enabled, right? That allow you to see things in inefficient parts of markets that you wouldn't otherwise, because these businesses aren't banked very traditionally, right? The way you're bringing operators or evaluating operators to make sure that you're running these businesses or providing them with the best practice and helping them build out whatever functional area that they need to help them scale and grow into perpetuity, which is what we're all excited about. Like that is, hearing this here now is what gets me excited about the GP universe approaching growth equity with a very different lens than what it was pre-21, which was momentum, kind of just paying whatever price you could for logos and high growth rates at that time. But I think everyone understands now that business models are different. That kind of quality of revenue endurance factor that we were talking about is different, and saying how can we actually change the trajectory of this business ourselves as an active owner is.
How good are the CEOs at listening to that in terms of taking it on board? Because I mean, in the private equity sense, we see value creation as providing very specific, targeted, functional pieces that help companies grow out of issues. How good is that in reality in terms of CEOs listening, taking it on board?
I think for us it's interesting. We've known our CEOs for 18 months before we invest. So it's never really this like shotgun marriage where there's a term sheet and we jump in the middle of it. So by construction, we're hopefully finding CEOs that want to work with us, see a vision, and most importantly, want to work with our operators and our teams to help scale. But we definitely get it wrong sometimes. And when you're an entrepreneur, you just have such a strong will, such a strong mind. There's definitely a series of cohorts where and to me, it's trying to figure out, why do we get it wrong? Can we figure that out early?
I mean, it's interesting. We've built an operations team that resembles a bio shop. It's 100 operators. We got all the tools, a little custom made for growth, but it looks alike. The difference with the buyout world is we don't control. So we give you the menu, but if you don't want to use it, you don't use it. So our hack is the prenup. At the end of our due diligence, we create a joint value creation plan. And we suggest a series of activities before we get married. And we sign up to that. And by and large, people are their word.
That's the observation I would add is that, seeing this across a number of GPs, the entrepreneur, the management team is so receptive to this now, right? Yes, they're dilution minded. They don't want to give up a huge piece of their pie, but if you can grow that pie together with real impact, that's, I think, what they're receptive to.
But it changed post-correction. Before the correction, no one wanted help.
That's right.
Now we all ate a little bit of humble pie after the correction.
A little bit of humble pie goes a long way.
This has been great. We're getting a please wrap here. So I'd like to thank the panelists. Thank you in the crowd. Have a great rest of the conference. Thank you.